What's going on, guys? Welcome to my channel. I'm the cover call guy. My goal is to create $120,000 per year passive income using only cover call ETFs. Right now, I yield about $72,000 a year and about $6,000 a month, almost $1,400 a week, and about $200 per day. Legal disclaimer before we start this video. This content is for information and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. Remember, I'm just some random idiot you found online and I could be completely wrong. Now, with that out the way, let's get started on today's video. It's going to be about WPAY. Now, you guys know, if you're a new subscriber, I have a weekly ETF, Maggie, and I'm trying to add another weekly payer. It's going to be either WPAY or blocks, maybe both. So I've been keeping my eyes on most of these weekly payers, including WPAY. So WPAY has put out their distribution, and guess what? It's a big hit. So we're going to be looking at the structural alpha, fiduciary discipline, and mechanics of NAV preservation from Roundhill weekly pay. WPay is going to be an analysis. We're going to discuss what is up with their pay, for the payout. Weekly pay from Roundhill WPay has cut their payout by 50%. This payout, holy moly, what is happening? Is this good? Is this bad? For those who are thinking about owning it like me, what do you guys think? And for those who own it, what is your thoughts? Are you surprised? Are you shocked? Are you angry? Or you know what? Or you might have the same thought as me as I go to this video. Let's see. Let me know if you guys agree with me on this or not. Especially for those who own it, and especially for those who have big money in this. All right, this is gonna be my verdict, right? The cover call guy's verdict. The smart cut. I'm gonna say good job to Roundhill. Round of applause, guys. Let's hear it. Round of applause. The situation, the recent distribution announcement of 0.34. Let's just round it to 35 cents per share. A significant reduction from the peaks of around 80 cents, typically around 60 to 80 cents, right? Or even 50 cents. Has pre pipicited a polarized reaction. I'm seeing a lot of totally different reactions. I keep a notification tab on Roundhill and the WPay, and then when I saw this, I had to go in and read up on it, and I saw a lot of different reactions to it. Some are very angry, and some are going, okay, maybe this is expected because of the market downturn and it's leverage. But I'm gonna give my thoughts on it, and maybe you guys agree, maybe you guys disagree. But the situation here is income-centric investors conditioned by high-yield option funds often view this reduction as a failure. Do you view it as a failure? My analysis, forensic analysis validates the thesis, which is my thesis. I'm saying the thesis, but this is my thesis. This cut is a fiduciary necessity to preserve NAV. What I think Roundhill is doing is that they're saying, look, we gotta learn the lesson from YieldMax. Right? OT has been paying 80, 90, 100, 110% regardless of the market condition. Just pay out the 100%. Roundhill is saying, look, let's not do that. Let's just cut the pay by 50% and preserve the NAV. Right? Unlike YieldMax, the funds that sell upside, WPay derive yield from leverage bullish price action. In short, I say it's not a warning sign. It is evident of proper risk management. Again, round of applause to WPay and Roundhill. This is a good thing, in my opinion. I'm going to view it as a good thing. They're doing this to preserve the NAV. It is easier to get back to 50, 60, 70, 80 cents payout, and it is harder to actually preserve and get back that NAV if you go ahead and keep cutting it like this. Because in a prolonged bear market, if you keep doing this to the NAV, it may never recover to the inception price, which is I think around like $50.40. I think. Correct me on that. It's about $50. So good job, Roundhill. If Roundhill keeps doing this, I'm probably gonna go ahead and put $1,000, $10,000 into it and let it ride. All right, the tale of two architectures, right? Source of the yield, we always got to figure out where it's coming from, right? It's in all my videos, it's all my deep dives, it's all my forensic analysis, my Sherlock Holmes, magnifying glass, where is the yield coming from, right? The feature, primary mechanism, strategy A, erosion max, yield max. Okay, yes, yes, haha. That's what I would nickname it, erosion max. Um, short volatility, right? Synthetic cover cost versus strategy B, the weekly pay, WPAY, leverage directional, right? Because it goes in up and down, either shoot up or shoot down. 1.2x total return swaps, upside potential, yield max is capped, WPAY is uncapped, yield source, yield max option premiums, sold calls, WPAY excess capital gains, which is the leverage rally, right? We want it to be in an extreme bull market. Down market behavior, yield max, NAV falls, premium paid out, deletes capital, right? Erosion max, completely deletes it. WPAY, however, NAV falls 1.2x. Distribution is cut, stop to preserve capital. Is what I think they're doing this intentionally. Summary. Well, stable income, right? Unstable NAB. WPAY is unstable income, but stable, convex NAV potential. So they're trying to preserve one or the other, and they're going for NAV. Good work on Roundhill for that. All right, clarification on swap mechanics here, because for those who are new, welcome to the channel. We only do a cover call ETFs or income investing and financial news. And today, WPAY, if you're thinking about it, right? One, no margin debt. WPAY weekly ETFs do not borrow cash to achieve a 1.2x exposure. Leverage is delivered via total return swaps, preventing traditional margin calls. They have collateral management. This distinction matters because the fund must settle swaps losses from its collateral, which is why preserving cash during down weeks is vital for survival. And of course, vital preservation by cutting payout in down weeks, which is what it did. The fund ensure it retains enough collateral to maintain the 1.2x exposure for an inevitable rebound. Right? How the math works? Of course, I think this is how it works. The distribution formula, because remember I think this is how they put it. A lot they don't really talk about how they do this or their formula behind this. So the disclaimer here: this is not the actual Roundhill formula, but a simplified model demonstrating the economic relationship. Because if you watch my previous video, they have proprietary secrets, so they're not gonna put out how they do things. This is what I think they do. Bull week 1.2x leverage creates excess gains. This is distributed. Bear flat market formula yield zero. Payout is cut to minimal return on capital to preserve assets. Note on return on capital, however, can appear during profitable weeks, right? Tax optimization, and does not inherently imply NAV destruction. The math behind the 0.35 cents payout. I think this is what's happening behind the scenes until they release actual new data. This is kind of going off on previous data that they released. So this is just the holdings, and this is what's happening and how to get it. Right. So Google, Robinhood, Tesla, NVIDIA, Palantir, Amazon, MicroStrategy. Right. So a lot of stocks that were affected. Obviously, their payout wasn't great. And instead of eating away at the NAV, they said, you know what, let's just give a lower payout. Defining NAV erosion versus preservation. So I think a lot of people were upset. From what I'm getting, a lot of people were upset because, I mean, if you're living off of this, right, you have the right to be upset. But again, it seems like the people that were upset didn't understand what they were holding and buying. They just saw how great it was when it was released and it was going up, and up, and the payout was amazing. Oh yeah, I'm a genius and I bought this, blah 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 blah. But I don't think they truly understand that they were buying a leverage ETF, and so they think the NAV is unable to pay out. So they're seeing a NAV erosion, which is the trap, and they're kind of upset that instead of eroding the NAV, they're cutting the payout by 50%. For me, they kind of got it backwards, right? You rather have the payout cut than the NAV, because to grow the NAV again, it's going to be much harder. It just doesn't make sense. You'd rather have the underlying do well and then just pay out more, right? That's the simpler way. Right? Occurs when a fund distributes more cash than it earns, forcing the liquidation of assets, the collateral, to fund the dividend. This permanently reduces the share count or swap exposure, making it mathematically harder to recover the previous high water mark. Like I said, I'd rather just give me the pay cut for this month, the next 2, 3 months, 4 months, and then let the NAV be stable. And then when the market's doing better again, and the mobile bull market is shooting back up again, we're going to the moon. It's a leverage stock. It's going to pay me more. You know, when you invest, you should always account for this, right? You should always have like 10, 15, I would say even upwards of like 20 or 30% buffer. Like if you are trying to, like if you know your survival is to survive month to month, you need $5,000 US dollars a month. You should account for at least, aim for $775, $8,000 a month. Have that extra buffer, because if something like this happens, you're getting paid 8,000, every month, and then you have a cut like this, and it affects you down now to 5,000. You're like, wait, I'm good. I'm all right. I don't have to worry. And then all the extra months that you've been receiving, the extra 3,000, you should be smart and don't spend it all. All right, you know what? Why would you spend it all? Put it away, save it, or reinvest it to even increase your monthly to 85, 9,000. I think a lot of people that are upset that from what I'm reading on these comments, they're either spending it all and not reinvesting, or they didn't account for the cut. All right, so the weekly pay solution, by cutting the dividend to 34 cents, WPAY avoids selling collateral. It accepts a temporary drop in share price, which is market driven, but retains the full swap exposure to capture 1.2x of the recovery. I think people are very short-termed, or short-minded, and short-visioned, because they're not seeing that this is temporary. Don't be upset just because they cut it 50%. The next month, in 2, 3 months, it might just be back up to 70%, 70 cents, 80 cents. It's very market dependent because it is a leverage stock, so it will fall a lot lower, but it will also climb a lot higher. All right, so this is scenario analysis. I like to do these scenarios. I'm a scenario guy. A 5% market drop, right? Market impact forces strategy A. Again, we're using yield max, right? Force the yield, NAV drop 5%, delta affected. WPAY, NAV drop 6%, right? Is leverage. What it distributes, pays 0.50, right? Funded by selling principal, which yield max does, versus WPAY, right? Pay 5 cents. Nominal return of capital only. Recovery needs a 6.38% gain to break even, and then WPAY needs a 6.48% gain to break even, because when you drop lower, you need it to rise higher too. That's just how leverage is. Upside capped. Yield max is capped. If stock rallies 10%, fund gains about 2 to 3%, and then WPAY uncapped. If the stock rallies 10%, the fund gains 12%. The result: erosion. Fund cannot recover because it's capped. Its own upside, yield max, and preservation. Right, fund retained full capital to capture the 12% rally. WPAY. All right, investor psychology and profit, portfolio fit. Right, the income chaser bias. Investors seeking a weekly salary real drop of 80 cents to 34 cents as a pay cut. They mistakenly assume the distribution trend is linear. Right, I think that's why the people are angry, because they don't actually. They just look at the numbers, or like some people that read the news and just read the title and not actually read the article, and they'd be like, "Oh my God, what's happening? The world is ending." Right? The reality is weekly pay distribution or event based, not trend based. Right? A low distribution simply reflects that the underlying asset did not moon that specific week. That's it. That's it. You might have a better week next week, or you might have a better month next month. They're very impatient, and didn't, they don't know what they're holding. They didn't know what they're buying. All right, the strategic implication: weekly pay funds are total return vehicles that monetize volatility. Treat high payout weeks as a bonus to be reinvested or skimmed, but do not rely on them for rent. Right? in my previous videos, I said that WPAY is a tactical play, meaning you really shouldn't be once you buy enough of your goal, like you wanted 1,000 shares. That's it. Don't go any more. Don't go any lower. Leave it as at 1,000 shares, and use that payout to fund your core. Right? WPay is leverage, which means it's not necessarily beneficial, right, to be holding it long term, because a lot of things can happen with a leverage, right? Because you might not recover. If we go into a prolonged bear market, that stock price is going to go down. And if we're in a prolonged bear market, if the market tanks, I believe, like, if it's severe, like a real market correction, if it tanks, I believe the math behind it is like 50 or 60%. But it doesn't have to drop 60% right away. I'm talking about prolonged bear market, a year stretched out, 18 months, right? If it drops like 3-4% every other week, the leverage stock, if it does not have enough collateral, will be liquidated. Do not get that mistaken. That is why people argue, wait, leverage stocks are not for super long term, right? It is a tactical tool. Use it to build other positions up, because you might have a 34-cent week this week or the next week or a whole month or two, and then when the market starts to moon again and your underlying starts to do well, you go from 30 cents to 80 cents, 90 cents, a dollar, $1.50, depending on how good it is, right? Use that payout to build up your core positions. Validating my thesis. This is just my opinion. I have to put this out there. It's just my opinion, right? Um, The data unequivocally supports the conclusion. The 35 cents payout is not a failure. Okay? Not a failure. I think Roundhill WPay is doing this on purpose. I think they are seeing the trend in Yield and all the investors fleeing. And they're saying, wait, hold up. We shouldn't be doing what Yield is doing. Lesson learned. We are gonna do what Roundhill does best for Roundhill, right? Don't copy the Yield um, strategy or their model, right? It is a fiduciary discipline in action, meaning this cut, it means that the fund manager in charge of WPay is saying we shall protect the shareholder at all costs. If they have to lose on one end, we'll make sure the other end they don't lose on. And then fact check passed, right? WPay cut the distribution by about 46% because high beta components, MSTW and the NVDW, PLTW, experience price consolidation. This is out of Roundhill WPay's hands. Mechanism validated, it just means that the cut prevented the fund from liquidating NAV to pay a fake yield, avoiding the erosion cycle seen in capped upside pairs. As you know, I like to always look at the yield. Is it faked or is it real? My final verdict: weekly pay funds are unstable yield vehicles with converse NAV potential. Yield max funds are stable. Wait, sorry, this is mixed up. I got that. Yield max funds are unstable yield vehicles. Weekly pay funds are stable yield vehicles with Oh God, how did I mix this up? With a non-decaying NAV potential. Sorry, guys. This is I completely mixed this. I was such a rush to type this out. My final verdict is weekly pay is doing a good job. Excellent job. Hopefully you guys don't have this on mute and you guys are just reading this. Weekly pay, good job, good job. Round of applause again. What did I have? Oh, my final verdict, my final tick, right? WPay is behaving exactly as designed. The distribution volatility is a feature, not a bug. They're doing this on purpose. It is the price you pay for uncapped upside. From the cover called guy, that's me. Join the conversation. Join my conversation, guys. I really like when you guys leave a comment and you give your thoughts in it, because then it allows me to expand my horizon and my view. It makes me brainstorm a little more. Smash that like button if you learn something about NAV preservation from WPay. Comment: are you buying a dip? Are you scared of the cut? Let me know below. Subscribe. It really lets me know that you guys are appreciating my work, my channel. Subscribe for more forensic ETF analysis and my honest takes. I like to say it how it is. There's no BS. There's no fluff. If I'm wrong, I'm wrong. I'll let you know. I'll pin your comment. like I do. You know, I have people that can vouch for it. There's people that say, hey, you're wrong about this. Here's the facts. And I'll go and research it. I'm wrong. I pin you. Thanks for correcting me. You guys make me a better investor. You guys make me a better YouTube content creator. You make me a better person overall. So appreciate it. Like, comment, subscribe. Thanks for watching. Catch you guys in the next.